Hello, welcome to Accounting 2010 Chapter 11 videos. In video 2 of Chapter 11, we are going to be looking at a comprehensive payroll example. This is part 1 of 2 videos. In this video, we're going to be evaluating Roadrunners Roost weekly payroll and constructing a payroll register. And Roadrunners Roost has 4 employees, 4 people who serve as tutors for the company. Kyle is the lead tutor and he is paid $30 per hour, and he typically works a standard work week of 40 hours. However, this week for this problem we are going to have Kyle working 50 hours because the Principles of Accounting students are having their first exam next week, and he's going to work 10 hours of overtime. And when you work overtime, you are typically paid at 1.5 times your standard hourly rate. So for Kyle's overtime hours, he is going to be paid $45 an hour, 1.5 times the $30 per hour rate. Roadrunners Roost employs 3 other tutors who are paid $15 per hour, and this week they worked the following number of hours. Sarah 25, Javier 30, and Shaza worked 40 hours. So we're going to be taking this information, and we're also going to be looking and evaluating how much each of these employees had earned to date. In the case of Kyle, he's worked a lot over the last year and he's earned $120,000. And this is going to be important when we're evaluating which taxes, the amount the employees have paid to date, because the amount can be subject to ceilings for Social Security OASDI and also for the federal unemployment tax, FUTA, and the state unemployment tax, SUTA, and there are ceilings for which we have to make tax contributions on employees' pay. So for the purposes of this problem, we're also going to be using a federal tax rate of 15%. Now we know from the previous video that when we fill out the W-4, the withholdings will vary from employee to employee, so that the tax rate may vary somewhat. But for the purpose of this problem, we will apply a 15% federal tax rate. We're also going to assume that each employee contributes 10% of their weekly earnings to a 401k, a retirement plan, and they also must pay a $100 minimum catastrophic health insurance plan premium, as is now mandated by the federal government through the Affordable Care Act, that all Americans, with few exceptions, must have a minimum level of health insurance. So for the purpose of this problem, we're also going to use this payroll table that we had talked about in the previous video. And we are going to be using, for the purpose of this problem, the 2015 Social Security OASDI rates and limits for this problem. Now your textbook may suggest other tax rates as it pertains to the employees. I believe the textbook uses a 4.2, and it has a different limit of $110,100, I believe, but we are going to use, for the sake of this problem, 2015 rates of the employee-employer both paying 6.2% for OASDI, both the employee and the employer paying 1.45% for Medicare, and the maximum taxable earnings for the purpose of Social Security of $118,500. So let's go ahead and jump out to a problem within the spreadsheet that we can work on to demonstrate all of these concepts that we've been talking about. So in a business, you can have a payroll register which will record all of the different the earnings to date for the employee. This is the earnings to date, any current period earnings, and then what the ending cumulative earnings are at the point that you recorded the current payroll. In the payroll register, you'll also calculate for each employment the OASDI, Social Security tax, the Medicare, any federal income tax withheld, any withholdings for health insurance and 401k, and we will add up the total withholdings to give the net pay, the amount that each employee will actually see on their paycheck by the time all these calculations have been performed. So what I have done is I have entered in the beginning cumulative earnings for each employee as were outlined in the previous slide. We have Kyle, Sarah, Javier, and Shaza. And we also have how many hours they worked and their rate of pay. I've included down here so we remember that the federal tax rate as well as any of the contributions for 401k and health insurance. And over here to the side we can see the payroll tax table so that we can properly apply the right percentages of tax rates or taxable amounts to each of the employee's current period earnings. So step one is we're going to calculate what were the current period earnings for each employee. So the first person is Kyle, and Kyle worked 50 hours, and we just said in the previous slide that if you work over 40 hours, you are paid at 1.5 times the rate. So Kyle worked 40 hours at $30 an hour for a flat rate, a standard rate of $1,200. And Kyle also worked for an additional 10 hours at a time and a half, 1.5 times the rate, which would be equal to $45 an hour. So, excuse me, we had 10 times $45 an hour of $450. That means that Kyle had a current period earnings of the $1,200 at the standard rate plus $450 at the overtime rate of $1,650, and we can plug that into our payroll register. For the other employees, none of them worked any hours over the standard 40-hour work week, so they will all be paid at their normal rate of pay. So the normal rate of pay for each employee was $15 times, in the case of Sarah, 25 hours, and we had Javier at $15 an hour times his number of hours of 30, and we had Shaza, who worked at $15 an hour times 40 hours, and there is Shaza's pay, and we can enter in those amounts into our payroll register. All right, this now can give us what our ending cumulative earnings are for the period, and this is important because we're going to be analyzing this to see if we have reached any ceilings as they pertain to the different tax, Social Security, Medicare, FUTA, SUTA, any of those taxable liabilities. So we are going to go ahead. We've entered in Kyle. He had $120,000 plus $1,650, gave us ending cumulative earnings of $121,650. We can simply use Excel to go ahead and drag and paste all of those formulas down to see the ending cumulative earnings for each of our employees. Now we're going to be looking at the OASDI taxation. I'm going to delete this Medicare. Those are not accurate amounts. So OASDI, Social Security, let's take a look and what does it say. OASDI, 6.2% up to a current year ceiling. Now in your book it is 4.2% for the employee, but this was part of the tax holiday we talked about in class. But for this problem we're going to use the 6.2%. And we said that the current ceiling, according to the information for 2015, if we go ahead and jump back out, is $118,500. So after an employee reaches $118,500, neither the employee nor the employer must make a contribution to the Social Security fund. So Kyle, none of his earnings were below the $118,500 at the beginning of this pay period, so none of his earnings are subject to Social Security. However, Medicare has no ceiling, so all of Kyle's current period earnings are subject to the Medicare tax, and the Medicare tax, if we look, is 1.45%. So if we take 1.45% times Kyle's current period earnings, we will see that Kyle must have $23.93 withheld from his paycheck. And if we look, none of the other employees had reached Medicare does not have a ceiling for any of the employees, so we can go ahead and click and drag for Medicare. But we must go back now and look at the Social Security earnings, taxable earnings on our employees, because none of the others had reached that ceiling of $118,500. So we must calculate the OASDI for each of these employees. So if we look over here, 6.2% for each employee, we can go ahead and go 6.2% times their current period earnings would give us the amount that must be held out of their paycheck for their contributions to the Social Security Fund. And as we did before, we can go ahead and select, click and drag, and populate the other cells with the amount of OASDI that must be withheld out of the employees' paychecks. Now, we said in the problem that the federal tax rate that we're going to withhold on employees is 15%. So we can go ahead and take 15% times the current period earnings, and that will be how much federal income tax will be withheld and submitted to the government on behalf of the employee. And we can select, click and drag, and populate the other fields. Down here we said that each employee must contribute $100 to a catastrophic health insurance plan. All Americans, with few exceptions, must have some form of health insurance due to the Affordable Care Act. So Roadrunners Roost provides an employee plan that meets the federal guidelines, and that is a $100 contribution to be withheld from the employee's paycheck. 401k is withheld at a 10%. So we can go ahead and write 10% or 0.1 times the current period earnings for each employee, and go ahead and we can click and drag. So there is the 401k contribution each employee will make to their retirement plans. And at the end of doing this, we can go ahead and add up how much in withholdings out of each employee's paycheck occurred due to them being employed by us. And we can click and drag and come up with the total withholdings. And after doing that, we can then determine how much net pay will each person be paid on their paycheck. And we simply do that by taking their current period earnings minus their total withholdings, and that will give them the amount that they will receive in the form of a paycheck. And again, we can click and drag and take a look. So in the case of Sarah, she earned $375 in her wages, yet after all of the amounts have been deducted from her paycheck to pay all her taxes, her health insurance, and a contribution to a 401k, what she actually will take home is $152.56. So what we've just calculated is our salaries and wages expense and how those expenses will be allocated. That is 1/2 of what our payroll expenses are going to be. It's the employees' pay less any expenses that come out of their paychecks to the different either taxing entities, benefits, or into their 401k. That is 1/2 of the problem. The other half is now as an employer, we have a responsibility, perhaps a responsibility to contribute to health insurance, 401k matchings, but also those tax responsibilities. So in this case, we did not see that we were matching any 401k or health insurance, but we do have the responsibility to make tax payments on behalf of our employees. So we're going to go ahead and take a look first at the table. And the table says under the employer payroll tax expense, the employer is responsible for matching any Social Security that the employee paid, matching any Medicare the employee paid, and then the employer is also going to be responsible for paying into a federal and state unemployment program, unemployment insurance program, so that if the employer lays off employees, the employees can apply for unemployment compensation. And so those rates are going to be for the federal 0.6% up to the first $7,000 of earnings. So we are going to have to evaluate each of those employees to see where they have their beginning cumulative earnings, any additional earnings, and where they're ending cumulative earnings. Now the first step is very easy because since we know that the employer matches on the FICA and the Medicare, we can go ahead and just copy in the FICA and the OASDI and Medicare taxes into the payroll tax register and go ahead and just put that in there. So that's pretty easy. It's just a matching amount. So we don't have any real issues when it comes to this. But now when we look at the FUTA and the SUTA, because only the employer is paying that, now we have some new calculations. So first step one, we have to analyze, did that employee at the beginning of the period earn more than $7,000, because then we've reached the ceiling. Well, in the case of Kyle, yes, so there is no more FUTA or SUTA to pay. In the case of Sarah, again, yes. However, for Javier and Shaza, no, they have not reached a $7,000 level, so there are some portions of their current period earnings that will be subject to the FUTA and SUTA tax. So let's take a look. In the case of Javier, at the end of the period, did he go over the $7,000 ceiling? And the answer is no. That means that all of his current period earnings are subject to the FUTA and SUTA taxes. So the calculation for the FUTA, according to our table, is 0.6% times any amount between the beginning and the ending, which is less than $7,000. So all 450 is less than $7,000. In the case of SUTA, it is the same, but the calculation is 5.6% times the current period earnings would make, let's go ahead and do that again, 5.6% times the current period earnings would make us responsible to pay into the state unemployment insurance fund $25. Now, when we get to Shaza, it's a little bit more complicated. Shaza at the beginning had earned $6,900, and at the end she had $7,500, but the ceiling is $7,000. So how much of the current period earnings is subject to those state and federal unemployment taxes? $100, right? Because $6,900 plus $100 of this earning would put Shaza at the cap of which we have to pay unemployment tax for her. So we can go ahead and take those percentages, the 0.6% times only $100, the difference to get to the $7,000 cap, and we would owe $1 on Shaza, and we would, for the state, we would go the 5.6% times only $100 to get to the $7,000 is $6. So we have a total in SUTA taxes that we must pay of $31. So our total employer tax, payroll tax responsibility for our employees would be the sum of the OASDI, the Medicare, the FUTA, and the SUTA. If we were withholding other things such as health insurance or matching 401k or paying any other types of bills on behalf of our employees, then that would be recorded as well. Now in the next video, part 2 of this payroll example, we're going to take this information found in our payroll register and we are going to go ahead and enter it into our general journal so that we have it recorded in our books.